Home prices across the United States have been surging for over a year now. There continues to be a shortage of available homes for sale, which causes cutthroat competition for anybody in the market to buy. These two trends are working together to move the dream of home ownership further and further out of reach of middle-class Americans. If we just consider households with an annual income between $75,000 and $100,000, nationally, there are currently only 250,000 homes listed for sale those households could buy with a standard 20% down payment. Just before the COVID pandemic, there were 700,000 of those types of houses to choose from. To put it another way, there are 65 potential buyers for every one of those listings, which is nearly triple what it was in 2019. And this doesn't even include the investors who want to buy those homes and turn them into rentals. Now, you could jump on the bubble train. That thinking goes something like this: houses are overvalued, we're in a housing bubble, and all you need to do is wait for the market correction and prices will come back down. Well, if you stick around for this video, I'm going to show you 4 graphs that will challenge that way of thinking. The affordability formula has 3 components: price of the home, the wages earned by the purchaser, and the mortgage rate available at the time. Conventional lending standards say a purchaser should not spend more than 28% of their gross income on their mortgage payment. Now, 15 years ago, before the housing crash, prices were high, wages were low, and mortgage rates were over 6%. Today, prices are high, wages have increased, and mortgage rates, even after the recent spike, are still well below 6%. That means the average purchaser today pays less of their monthly income towards the mortgage payment than they did back then. Now, the average wage earner can still afford the typical home, but the financial comfort zone continues to shrink as home prices keep soaring and mortgage rates tick upward. Here's a question for you: if prices are so prohibitive, how are so many houses being sold? Let's talk about lending standards. During the last housing bubble, it was much easier to get a mortgage than it is today. According to credit.org, a credit score between 550 and 619 is considered poor. In defining those with a score below 620, they say credit agencies considered consumers with credit delinquencies, account rejections, and little credit history as subprime borrowers due to their high credit risk. Now, buyers can still qualify for a mortgage with a credit score under 620, but they're considered riskier borrowers. Here's a graph showing the mortgage volume issued to purchasers with credit scores less than 620 during the housing boom and the volume in the 14 years since. Mortgage standards are nothing like they were in the past. Purchasers that acquired a mortgage over the last decade are much more qualified. Now, next, let's talk about foreclosures. The Federal Reserve issues a report showing the number of consumers with a new foreclosure notice. Here are the numbers during the crash compared to today. There is no doubt the 2020 and the 2021 numbers are impacted by the forbearance program, which was created to help homeowners facing uncertainty during the pandemic. There are currently less than 800,000 homeowners left in the program, and most of those will be able to work out a repayment plan with their banks. The primary reason there are so few foreclosures today is that today's homeowners are equity rich, not tapped out. In the run-up to the housing bubble, homeowners were using their homes as a personal ATM machine. Many immediately withdrew their equity once it built up. When home values began to fall, some homeowners found themselves in negative equity positions, where the amount they owed on the mortgage was greater than the value of the home. Some of those homeowners decided to walk away from their homes, and that led to a rash of foreclosures and short sales. Now, over the last several years, home values have continued to rise, which has led to over 40% of the homes in this country have more than 50% equity. But owners are not tapping into it like they did last time. Consider this: there's about $9.9 trillion in tappable equity out there, with the average home equity sitting at around $300,000. Not only have equity gains helped owners transition out of forbearance and avoid foreclosures, but they have also enabled many of them to continue building their wealth. Based on this, there is virtually no chance we will see the same number of foreclosures as we saw during the last crash. The final thing I want to talk about is available inventory. A normal real estate market is considered stable, where there is about 6 months of inventory. Anything more than that is an abundance and will cause prices to go down. Anything less is a shortage and will lead to price increases. As this graph shows, there were too many homes for sale from 2007 to 2010, many of which were short sales and foreclosures, and that caused prices to tumble. Today, there's a shortage of inventory, which is causing this acceleration in home values to continue. Now, based on these graphs, it's very difficult to call this current market a bubble. You might be hoping for a correction, but if it never comes, prices will continue to go up. And if you wait, you will pay more for a house and probably a higher interest rate. Now, here in the Austin area, the rate of appreciation and the median sales price are much higher than the national numbers, including the graphs we looked at. So the big question is this: if you are in one of those households with an annual income in the $75,000 to $100,000 range, can you even buy a house in the Austin area? The answer is yes, but only if you have some flexibility. This comparison of three northern suburbs highlights what I'm talking about. Leander has been extremely popular, primarily because of its proximity to the domain where several big tech firms are located. Hutto has traditionally been overlooked, but there has been a tremendous amount of new construction there. Now, if you look at those drive times, you'll also see you're not giving up a lot of convenience in Hutto versus Leander. Gerald is about 10 minutes north of Georgetown on I-35. For a difference of about 15 minutes in drive time, you will pay $200,000 less for a comparable home and about half of the amount in property taxes as you would in Leander. One final thought. That $300,000 to $350,000 is what you would have paid for a new house in Leander about 3 years ago. It was the pricing in Hutto about a year ago, and now it's the pricing in Gerald. If your market correction never comes, do you really think those prices in Gerald are going to be the same in a year? Well, if you like this video, you should check out this other one that I did. And don't forget to subscribe to my channel and hit that notification bell. All of my contact information is in the video description, so don't be shy. Let's make your real estate dreams come true.